All right, let's talk SPACs. Specifically, those block check companies everyone's been talking about?
Yeah.
We're doing a deep dive on Perella Weinberg Partners.
Okay.
They went public via SPAC back in 2021.
Right.
And their filings, they're a really interesting case study. We've got their 10Ks from 2020 to 2023 all ready to go.
Yeah.
So get ready to really cut through all the hype and understand the mechanics of a SPAC.
And what's really fascinating about PWP is their journey.
Yeah.
They go from pre-revenue to, this major player in financial advisory.
Exactly.
It's a crash course in SPACs, but with a real-world example,
Exactly. So just a quick refresher for anyone who maybe, needs it. Imagine like a shell company.
Yeah.
Just a pile of cash. And their whole goal is to go public to find a company to merge with.
Yeah.
That's it. That's a SPAC.
Yeah, yeah. It's a very different animal than, say, a traditional IPO where you have a company with an operating history, right? Offering shares to the public. Here you're investing in, really, the promise of a future acquisition.
And that's how PWP started, as a blank check company, literally. They were called FinTech Acquisition Corp. Share All. And they were initially focused on fintech.
Right, and this is key, that initial focus doesn't necessarily lock them in, right?
Oh, okay.
So there's this NASDAQ rule that a SPAC's acquisition has to be worth at least 80% of its trust value.
Okay.
Which is basically the money they raise from investors.
Right.
But the industry, that's where SPACs, they have some flexibility.
So they could have gone after a company, not in fintech.
Absolutely. As long as PWP could be this is the fair market value, they could swing a deal outside of their initial scope.
Interesting.
Yeah. And this is where things get,
risky.
Yeah. Risky. How do you evaluate fair market value for a company that no one even knows about yet?
Yeah. And speaking of potential concerns, one thing that I thought was interesting in the 2020 filing was they mentioned possible conflicts of interest, particularly with officers or directors who might be involved in businesses similar to their target.
Right. And they don't name any specific conflicts in the filing, but it does make you wonder, how common is this in the SPAC world?
Yeah.
Are there really safeguards in place to protect investors if something shady is going on?
Yeah. We're already getting into some of the trickier aspects of SPACs.
Yeah.
And speaking of tricky, can you remind us how redemption rights work with SPACs? Because that seems really important for investors.
Absolutely. So this is a major difference between a SPAC and a traditional IPO. Right.
Okay.
You, the investor, can basically say, hey, you know what? I'm not sold on the company you're merging with. Give me my money back.
So like a money back guarantee.
In essence, yeah. And with PWP, the redemption price was set at $10 per share. But
there's always a but.
There's always a but. The founders of the SPAC, they waive their redemption rights under certain conditions, which, of course, are outlined in the filing.
Okay.
So they're incentivized to see this deal through, even if it's not in the best interest of everyone.
Right, right.
It's something to keep in mind.
So we're already seeing some areas where things can get a little iffy. And then there's this whole indemnification clause, which honestly sounded kind of scary when I first read it.
Yeah.
It's a mouthful.
It basically says that this entity, FinTech Investor Holdings the Fourth, LLC, they're going to cover certain claims that might, drain the SPAC's trust account below that $10 redemption price.
Wow.
It makes you think, how much risk are we really talking about here? Not just for the founders, but for,
everybody.
Everyone who invests.
Yeah, if they needed that, that's not a good sign.
Exactly.
So that brings us to the merger,
right.
Act 2, I guess, of our SPAC saga. So 2021, their 10K, we see PWP totally transform.
Yeah, it's a complete 180.
No more blank check company.
Nope. Language completely changes. Now it's all Perella Weinberg Partners, leading global advisory firm. They're highlighting their expertise, their client roster, their global. Yeah. It's a whole new ballgame.
So less looking for a target, more we've arrived.
Yeah, exactly. But even with all this, newfound confidence, their filing still has some interesting and potentially concerning details.
Like what?
Like competition.
Right, because they talk about being in this crazy competitive world of financial services.
Yeah, they're constantly fighting for deals, for talent, for every, percentage point of market share. And all this competition, it plays into their risk factors. One that really jumps out is that they rely on just a handful of clients for a huge chunk of their revenue.
Oh, wow. So if they lose one or two big clients.
It's a problem.
That's a problem.
Big problem. It's a high wire act, you know? They need to not only win new clients, but keep those big ones really, really happy.
Yeah. And then there's the whole issue of regulation in finance, which is always increasing.
Yeah.
That's got to be
done. Absolutely. PWP even mentions having a whole internal compliance team, you know?
Wow.
Systems, everything, just to keep up with all the rules.
So it's not just paperwork.
No.
It's a whole investment they have to make.
Exactly. Exactly. And speaking of investments, they also get into this whole thing about maybe becoming a publicly traded partnership.
Oh, yeah.
Which they really don't want to do.
Why not?
Well, it sounds complicated, but basically there are these tax disadvantages.
Oh.
They'd get hit with a big tax bill if they did that.
Makes sense. Nobody wants to pay more taxes. And while we're on the topic of things that can be unsettling financially, what about executive compensation?
Ah, yes.
Because, we were talking about those potential conflicts of interest earlier.
Right. And it makes you wonder if those conflicts might be influencing these compensation packages.
Yeah.
They detail some pretty big stock awards, which, it's not unusual, but it does make you think about incentives.
Totally.
Are they making decisions that are good for the company or just for their own wallets? It's like that saying,
follow the money.
Follow the money. Exactly.
Especially on Wall Street.
Oh, yeah. And here's another thing, kind of a red flag, maybe. Their structure, their holding company.
Okay, break that down for me. What does that even mean for, like, an investor like me?
So PWP, the company you'd invest in,
yeah,
it relies on its subsidiary PWP OpCo for basically everything. Dividends, money for taxes, operating expenses, all of it.
So if PWP OpCo isn't doing well,
PWP's in trouble.
Not good.
Not good. And that takes us to their 2023 filing. We get to see how PWP is doing, post-SPAC.
Okay, let's hear it. How are they doing?
It's a mixed bag.
Ooh.
Their 2022 report showed an operating loss.
Not great.
No, not ideal. But they also decided to buy back some of their own stock.
Interesting.
Which, some people see as a sign that they're confident about the future. It's a way to try and boost their share price.
Right, inspire some confidence. What about their plan for growth? Anything about that?
They're really focused on getting top talent and training them well, which makes sense, right?
Yeah.
We talked about that competition. Cutthroat. They got to stay on top of their game.
Keep those rock star employees.
Exactly.
And then there's this whole tax receivable agreement, or TRA.
The TRA.
I'd never even heard of that before reading these filings.
Yeah, it's one of those things that often gets overlooked in those quick conversations about SPACs. Basically, it lets those pre-merger owners benefit from tax savings.
Oh, interesting.
Kind of a complicated mechanism, but it's another way those early birds can profit from this whole SPAC structure.
Even after the merger's done and over with.
Even after. And here's another thing, and this is interesting. PWP doesn't have to give all its extra cash to the stockholders.
Wait, really?
Yeah, they can use it for other things, like acquiring more of a PWP OpCo.
So they could be sitting on a pile of cash that belongs to the people who bought stock.
Well, it's not that straightforward. They have flexibility, but they also have to think about their stockholders.
Yeah, right.
It's a balance.
And let's not forget about the dilution risk, which that's always a concern with SPACs.
Huge. Future stock issuances, they can really dilute the value of the existing shares, which obviously is bad for stockholders.
Definitely something to watch out for.
Yeah.
So, wow, we've gone from like blank check all the way to, global advisory firm.
And honestly, we've just scratched the surface of what these filings tell us.
Right.
But PWP, it's a good example of both the good and bad of SPACs,
Yeah, that fast track to going public.
Exactly. Much faster than the old IPO. But as we saw, with PWP, that speed can have a downside. Merging with a company that might not have a long track record, that's risky. And then there's the whole question of, are these founders and execs, are they really looking out for the average investor?
Yeah, and then trying to understand those complicated structures and the taxes and dilution. It's a lot.
It really is. You got to do your homework with SPACs. It's not just about buying into the hype. You have to get how it all works, the risks, and really, really look closely at the company itself.
So for everyone listening who's been with us on this deep dive into PWP and SPACs, here's something to think about.
Yeah.
After learning all this, do SPACs seem like a good investment for you personally?
It's a question worth asking yourself, and I'd say take it further. Look into other SPACs, use what we've talked about today, and see what you find.
Exactly. That's what this deep dive is all about, giving you the knowledge to really understand the world of finance and make smart decisions for yourself.
The learning never stops. Keep asking questions, be curious, and get different perspectives.
Until next time.